Good morning, Quasar Markets Live. After that brief respite, so I could get a little coffee and get resettled here, we have the man himself, Mark Putrino, to go over some charts with us. Mark, how are you doing this morning?
I'm doing pretty good. How about yourself?
I'm doing good, man. This market is fun to trade, but man, it is just a hectic market out there, right? We love volatility, so that part's great. But people seem, when things are moving to the downside, no one's in a good mood, it seems like.
Yeah, well, I mean, we talked about this last week, and I had said as long as Microsoft holds above that support, I would, kind of be leaning to the long side. And now that Microsoft has broken that support,
Right.
as long as Microsoft as long as Microsoft is below 407.50 ish, um, I would be leaning to the short side. And I think that the action in Nvidia is pretty interesting because supposedly the numbers
Yeah.
were really good.
Yeah, I mean,
Supposedly,
I would say two things on Nvidia. The dysfunction, the first few ticks showed you how algos play around with this stuff. And then you can see today, man, that pullback has just been strong.
yeah. So when you have numbers that are allegedly really good, and then the stock opens at its high and then just kind of sells off, that's telling me that everyone who wants a position in Nvidia either has it or maybe the numbers weren't as good as they initially seem, and people are seeing something in there that's kind of worrisome. But this is we've opened at the high of the day, and we're at like the low of the day. So you don't need to be a tech guru to see that something's going on there.
Right, for sure. And as you said, I've seen so many of them today that have dropped right through that spots that we talked about last week as the key support to watch. I was pointing it out before on the show that it just, one after another, it just seems like the key support levels have dropped through. Yeah,
Yeah,
right there. That bear flag went the wrong way for sure.
yeah, and I looked through. So here's the S&P, but we looked at Microsoft, we looked at Nvidia. Let's just look at these other formerly Magnificent Seven guys. Yeah, so Apple got up to this resistance that we talked about, and it failed. So a lot of times you get this is kind of an interesting lesson here in charting, right? We got up to a former peak, and that's really right where we found a peak this time. And there's this old saying on Wall Street that you sell at former peaks. And there's a reason for that. There's people who bought right here at the open that have been underwater, that went underwater ever since. And when it finally got back up to their price, they're like, gee, I can finally get out of this thing at break even. I'm going to. So
Yeah.
remorseful people that bought over here at the top, placing sell orders over here, created resistance at the same price that had been resistance before. And you can also see buyer's remorse when a level that was support turns into resistance, because it's people that bought here. And when at first they were like, oh, this is easy. But then when the support broke and the price goes down, a lot of them say to themselves, I made a mistake. And if it ever gets back to my price, I'm going to sell to get out at break even.
Yeah.
So you got remorseful buyers from here placing sell orders over here, and you got remorseful buyers from here placing sell orders over here. So this just goes to show you that in the financial markets, some price levels are more important than others. That's just how it is. And sometimes we know why, and sometimes we don't. But the good thing
Right.
is we don't
Sometimes
need.
it's just round numbers, right? I was looking at, I believe it, what was approaching Palantir was coming towards 100, and that was its tough spot. And we've seen that, with other things too. Round numbers can be a big problem.
Yeah, that's just the way people think, and it's not just the retail traders. I mean, I've seen institutional traders think the same way.
Yeah.
People, no one says, hey, if it gets to 98, I'm going to buy it. Or if it gets to 103, I'm going to buy it. People say, hey, if it gets to 100, I'm going to buy it. Right.
Right. Yeah.
And that's.
Yeah. We've seen it. Netflix, it broke 1,000 now. That's the resistance that it is. I would say personally, it's got to get above that. Again, that round number, it keeps beating it up.
Yeah, that's pretty wild here.
Huh. Yeah. So, we've seen it with a few of them. They're right at the round numbers right now.
Let's take a Google. Like I went through these Magnificent Seven, and I don't know what day is today, Thursday or Tuesday, and I was like kind of just shocked that they all look so weak. I mean, look at this. Like Google is just getting crushed over here, and you would think that there would have been some support at a former resistance level. That's what we got here. And this is the opposite, right? We talked about buyer's remorse. This is seller's
Yeah.
remorse. There's people that sell. And when the price goes higher, a lot of them say, I made a mistake. If this ever gets back to the same price I sold at, I'm going to buy my shares back. So when you get a sell-off and you get back to the level that was resistance, you have a tendency to find support. And this support held for about 2 weeks, but then we just broke down and then we just blew right through this 175 level. So that to me is indicative of pretty weak action. And, next stop.
And that's what I would say too, is my takeaway today, as I told people, I'm not necessarily buying the dip yet because it blew through levels. It didn't get any support where we thought support should have been on a lot of them personally. So
and that's like what we would refer to as like bad action in the trading world, right? It's not really something you can quantify, but like say a company has good numbers, like Nvidia, for example, they have good numbers, but then now the stock is getting shellacked. So that's what we would call bad action. And here's Facebook.
Yeah, it does it right. And that's what we're seeing. It's again, I hate to keep saying the same words, but tweet analysis is outranking technical analysis a little bit. And that's why I'm a little bit more wary on the market today than I would be normally. Is that, we saw it yesterday, right? Market wanted to recover, everything looked good. And then, we get a little news from the White House that we're going to, put tariffs on UK and EU, and markets rolled right over.
Yeah. It's wow. Then it looks like it's going to continue, but Tesla here looks kind of interesting. I mean, I know it's a ways away, but this stock can move this much in one day.
I would say I think it could hit it today. I actually called for that level this morning. I said, once it broke down below that 300 and got rejected on its first try to hit that round number of 300, I said that's really what you're looking at, is right around that 265, 267 area.
Yeah, and this goes back to October of 23 when it first became resistance. So resistance.
Yeah, and I would use Bitcoin as the reason also. It tends to be a precursor because it trades 24/7, and it broke down below that same support level, and now it's headed to its 200-day MA.
Yeah. Well, I would say Tesla, though, if this gets down to 265, that's where I would probably get interested on a potential rebound. And we talked about how there tends to be resistance at the same price levels that had been, there tends to be support at the same prices that had been resistance.
Yep.
And this is our buyer's remorse. So sometimes, seller's remorse. Sorry about that. So sometimes when you get to a support level, what is the support level? Well, it's a price level where there's a lot of buy interest, whether it's traders or investors. And sometimes they say to themselves, this stock was in a downtrend, and I know stocks trend lower when there's not enough buyers or demand around. Now it's got to 265 and it's not going any lower. So that must mean that there are other buyers coming into the market. Now, I don't want to miss out. I was bidding 265, but you know what? I'm going to go bid 266. And someone else could say, you know what? That guy's bid at 266. I don't want to miss out. I'm going to bid 267. And you get like a bidding war that causes a snowball effect. So you can see that here, right? We get to support and we rally. It's the opposite at resistance. This is when people want to sell. And someone might be right, you know what? I'm at 265, but the stock has stopped going up. And that tells me that there's probably sellers coming into the market, new sellers. I don't want to miss out. I was at 265. I'm going to go to 264. Someone else sees that and they're like, ooh, that guy's at 264. I don't want to miss. I'm going to go to 263. And you get this snowball effect. So for the people that are listening to me now, like, how does all this come together? And it's fairly simple. I mean, if something is making a move and it's getting close to a price level that had been support or resistance before, there's a good chance there's going to be support and or resistance there again. So we let the market tell us what to do without guessing. And because the market is never, the market is never wrong. And every human is wrong at some times. But if you let the market tell you what to do, like if someone said to me, like right now, should I buy Tesla right here? Maybe this is the bottom, but maybe not. I would kind of just be guessing. But I would say, based on my experience and the experience of the markets, if we get down to 265, that's probably where I would buy it. I don't think I would touch it until we get down there.
Right. And as you know, what we find is that, professional traders, folks that have been in it for a long time and continue to still have enough money to do it, start to develop those things, right? Because you get an asymmetrical trade, because maybe you're saying, I want to buy it at 265, but if it drops below 260, then that invalidates what I had as my thesis, and I'm going to get out there but my return level could be back up to that 330. So you start to get that, that asymmetrical trade setup that we look for, right? Too.
Yeah, exactly. You got it. It's all about like risk reward. If you're thinking, all right, a stock is at 10, and just to make the numbers simple, and it gets to 7, if I buy it at 10, my sell target is 12. If I buy it at 10, I'm going to get stopped out if it gets to 8. So now you have $2, $2 potential risk and $2 potential reward. It really isn't very appetizing.
No.
So you may not want to take a trade unless you think like, all right, if it gets to my target, I'm up, say 30%. If I get to my initial stop out level, I'm going to lose, say 5%. So there you have a 6-to-1 risk reward ratio.
Absolutely.
Or I should say reward risk ratio. Yeah. Well, you know what I'm saying.
Yeah, absolutely. But it's something that, a lot of new traders don't think about. And it's something that professional traders all think about and all wait for. That's why patience is a virtue. You don't have to jump into every trade just because it dropped X percentage today. So in the case of, like you're saying with Tesla, well, it's down, 20% in 5 days. Well, guess what? It can go down 28% in 6 days. That isn't the reason to buy. The reason to buy is because you see this support where it's been historically, bounced back from, and that's where I'm going to trust it. And because if it goes way past it, like what we looked at with Google, right? Google blew through where you and I were both looking at for support. It invalidated the trade. Like we said, it fell through that support far enough, to me at least, that I would have exited that trade, at this point.
Yeah. Now that's one of the things I like to teach my students, is something to think about here is, whoops, let me just bring up this relative strength index, is you got your setups and you got your triggers, right? The setup could be something like, all right, well, you know what? Google is getting crushed, and it's at a level that had been resistance before, so there's a good chance there's going to be support. So that's your setup. This is you're going to the racetrack, and the starter's like, on your mark, get set, but he hasn't said go yet. Right. What would be the go signal? Well, for me, the go signal to jump in, or what we would call the trigger, would be, all right, if the RSI line starts to turn up, then that's where I'm going to pull the trigger and start buying. Now, notice we blew right through this support. Now, if I was if I was guessing, although albeit I would say an educated guess, there's going to be support around 175. I'm going to get ready, but I'm going to wait for the reversal to start. So because this trade never got triggered, in other words, the RSI line has not turned north yet, I wouldn't have taken the trade, and I wouldn't have been in a losing position. I mean, you're going to give up a little bit because you're not going to get the exact bottom where it turns, but I think it puts the risk reward ratio much more into your
right. I like to see it bounce off that support before I'm going to start to get into it. For me, it isn't about trying to get the last penny. I'm not jumping in front of a steamroller to pick up a penny. And, I'll let it, like you're saying, I'll let it see it bounce off that level a little bit. Let's see RSI turn. Let's get a nice turn there. I used, some other momentum, some EMAs, maybe super guppies that would show that momentum turn, and looking for that momentum first to move to the upside before I follow in. I don't want to necessarily be the leader. I want to be the guy at the door that's taking in your tickets as you want to leave the market. And when you want to get back in and we're sold out, I'm going to sell them to you like a scalper.
Yeah, exactly. That's what, this short-term trading is just taking advantage of equilibrium imbalances, I guess I should say.
Yeah, absolutely.
Right? And if we think about this from let's put on our fundamental hat and pretend we're both fundamental investors. How is it possible that this company has lost 20% of its value since February 4th? So in less than a month, Google has lost 20% of its value. And this is a company that's worth over $1 trillion. So it's lost, what, $40 billion in market cap? Am I saying that right? 40 billion? Yeah. And like, what's changed? Was there a fire at one of their factories or something? And the only thing that's changed is
Google stopped making, devices. Is it not making? Do they not have a cloud anymore? Yeah, you're right. That's where. But the bottom line is the psychology of the market matters to it also, right? And these are the spots that we're pointing out. It's just psychology, where people are remorseful because they sold or remorseful because they bought.
Yeah, yeah, exactly. People try to guess, and you know, well, the last time we had this, AI, like whatever euphoria, people seem to forget because it was before COVID. But probably about 2016 and 2017, there was a lot of people talking about AI.
Yeah.
And I actually did some consulting work with a couple AI scientists who wanted to get away from what they were doing and get into the financial markets. And these guys were probably some of the stupidest people I've ever met. but anyway, at the time, because AI was so popular, it was fairly easy for fund managers who are saying we're using AI in investment process to raise money, right?
Money. Yeah.
They say the hardest thing to do on Wall Street is to raise money. And the second hardest thing to do is keep it. And I'm talking about being like, if you're a money manager, if you're a hedge fund manager.
Yeah.
And you get this thing where, because we talk about emotions, right? It plays into this. There's a lot of paper trading systems that work, and there's a lot of really good back tests out there on Wall Street, right? But if you don't have experience with actual money, then it's going to have a hard time raising money, because people are going to be like, well, this is just on paper. What's it like when you have
what's
real
it
money?
like when it's live and everything's coming at you? How do you handle that? That's a big one. I haven't asked you that question about, although I guess I'm probably going to know your answer a little bit, is how you feel about paper trading, because I like it to figure out the mechanics of how to use something, but with no skin in the game, you don't learn, and you don't have the emotions that hit you. I've seen some of the greatest paper traders in the world who, as soon as they had a dollar in the game, couldn't keep to their strategy. In the same way, I always talk about people that I golf with, that if you put a dollar on a putt, they always miss the putt. I have a few friends that if they're beating me and I want to win for the day, all I got to do is say, hey, a dollar if a dollar on this putt, and it could be a 2-footer and this guy's going to send it 6 feet high. It's just true. Some people don't have the wherewithal. I always say great poker players make great traders.
Yeah, because they understand the emotions.
Emotions and risk management.
I like to use analogies, and I think in a lot of ways you can analogize trading to golf, in the sense that it's a game of it's like a golf pro one time told me golf is a game of misses, right? It's like, just worry about the bad shots and the good shots will take care of themselves.
Yeah.
And
learn where to miss is what I was taught. Exactly. Like, you got to know where the miss is going to not hurt you as bad as where, if you don't watch it.
And it's not precise either. Like, Tiger Woods doesn't get a hole-in-one on every hole, right? It's about just trying to get close, because it's very, very hard, if not impossible, to have perfection, right? Yeah. And it's the same thing with trading.
Absolutely.
People get too upset. Oh, anyway, going back to my AI thing, though, talking about what we're just talking about here. So a lot of these funds that were able to raise money using AI for their investment process are like out of business now, because the performance was so bad. So you could be some, data scientist from NASA who's got 160 IQ, and you everything about this statistic and that statistic, and guess what? Your performance could suck, and because it doesn't incorporate the emotions. And when we talk about artificial intelligence, right, in every market there's a buyer and a seller.
Yep.
So what if the buyer is using AI and the seller is using AI? Right? I mean, which one is better? That's not going to change, right? In markets, there's always going to be a buyer and a seller. So
absolutely.
So it's people overcomplicate this stuff. And if you just think about the stuff that we talk about here, if you're a short-term trader, it's, the levels, it's the momentum, it's the psychology, it's maybe some of the patterns, understanding like why a pattern would form.
Absolutely.
Is another, like, some people like look at things and they say like, oh, this is this pattern or this is that pattern. And what was I looking at? Was it Live Nation? LYV? But they don't understand the trading action that makes the pattern form. Like, right. Japanese candlestick charting goes back to the 1500s, right? The rice traders are the ones who came up with it, as far as we know. And they were looking at the same pattern 700 years ago as we're looking at
Amazing.
now. And that's because people have the same emotions, right? Now,
Yep.
let's just look at this. This is what we call the old bearish engulfing pattern. Okay. So we're in this uptrend. The bulls are in charge here. And on this particular day, it looked like it was going to be another up day because the opening price was higher than the
Yeah,
prior
new
day's
higher
close.
high. Yeah.
But by the close, what happened? The sellers came in and they overpowered the buyers and pushed the stock all the way down to where, and this is the important part, that we engulfed the prior day's trading range. So sometimes the change in leadership takes place over an extended period of time, and that might show up as like a rounded top or a rounded bottom. Sometimes the change in leadership takes place in one day, and that could
Yep.
show up as the old engulfing pattern. So it's not a matter of saying like, oh, is this pattern or is this that pattern? It's a matter of just looking at this and just understanding like, what does this show that is going on in the market? And to me, it shows that, gee, the sellers have overpowered the buyers, and this is a trend that changed in one day. On the opposite, you can have your bullish engulfing pattern down here. So this looked like it was going to be another down day, right? The opening price was lower than the prior day's closing price. But by the end of the day, the buyers came in and overpowered it and took it all the way up. And the action or the trading range engulfed the prior day's trading range. So it's not a matter of saying, is it this pattern or is it that pattern? It's more a matter of, it's more a matter of just understanding the price action that makes these patterns form on the charts. Right. That's
Right.
what
Would
we're
you
trying
also
to.
say it's a little bit, you got to play the hand in front of you? I think that sometimes people get too stuck on one sort of thing that they use in their trading. And that doesn't fit every chart that you're looking at. It might be great for a bullish setup. It might be great for a bearish setup. Maybe it doesn't work in a mixed market or a volatile, or the opposite. It doesn't work when markets are fairly calm.
Yeah. Got to be flexible. Have some kind of
Yeah.
flexibility. A big problem people have is, the sentimentality. They fall in love with the stock, and they might buy a stock, and say you buy it at 10 and it goes to 100. It's like, oh man, I love this stock. This
Yeah.
is my favorite stock. This is easy. And then it goes to 90, and you're like, well, whatever. I'm still up 9 times. And then it goes to 80. It doesn't matter, whatever. I'm still way up. And then it goes down and goes down and goes down and goes down. And you
Right.
finally had what was a hugely profitable position becomes a losing position because people fall in love with their stocks. It's called like a
Yeah,
sentimentality.
we always say that is don't fall in love with any stock. You owe it nothing, it owes you nothing, and you got to have that mentality. There's thousands of them, and you pick and choose them for that. And don't get me wrong, I know people that only trade one or two stocks because they learn the price action the best on that. I don't have any problem with that. I have a friend who only trades QQQ. That's it. But he just has a feel for QQQ.
Yeah. It's like everyone's just got to have their own strategy. I mean, if you're a market maker, your whole life is based around trading a certain list of stocks.
Right.
If it's a really active stock like Nvidia, that might be the only stock you make a market in. I mean, I
Yeah.
remember.
Scott Bauer was Amazon for 3 years in CBOE. That's all he traded.
Yeah, like when I was first coming up back in the late 90s, there was so much trading in Intel and Microsoft. I remember I was at Smith Barney's trading desk one day, and they had four market makers, four guys that were making markets in just Intel. It
Isn't
was
that
so
crazy?
busy. But now if you got into the industrial area or somewhere
Yeah,
else, you could have
absolutely.
a market maker making markets in 20 or 30 stocks.
Right.
But it's that's why when I was doing the Benzinga trading school, I would get a little frustrated because there was a lot of this pressure on me to be like, let's do some live trading or show what you would do or whatever. And I know that sounds fun and everything, but everyone is different. So just because I do it doesn't mean that someone else could do it in my style, right? And maybe
Absolutely.
I couldn't trade their style. And going back to a golf analogy, you don't go to a golf pro to hire them to go play golf for you, right? I mean, you go to a
Right.
golf pro so they can teach you what your strengths are and what your weaknesses are. And you got to develop your own swing and your own style and your own philosophy and so forth and so on.
I think that's so important what you just said there, because a lot of educators don't have that view. They think that their system is the right system, and you've got to learn my system and trade how I trade. What I like to do, and it sounds the same for you, is we teach them how to fish. I'm not taking you to my fishing hole, but I'm going to teach you what I look at to find the right fishing hole, to get the right setup, to have the trade that I want to get into.
This could be an interesting setup here, this Salesforce CRM.
Yep, drop to there.
Because, we sold off and we're down to this price level that was support back here around 295. So there we go with our nice round levels. And, we're at the level that was resistance. So again, right, if we talk about our trigger, we could say that this trade is set up. Where is this here? This trade is set up. Now, my trigger to actually go and buy it would be if the RSI line turns up. And notice how it hasn't turned up yet. So I would just be on the sidelines here. If this thing starts to rally a little bit, that would make the RSR line turn up, and that's where you jump in.
Yeah,
so
absolutely.
I'm okay with not getting
finished closing its gap. It's done a bunch of good things.
Yeah. So here's an example of a gap that refills, right? So we gapped up. And one of the main reasons, as we talked about, why you get support is because you have remorseful sellers trying to buy stuff back. People sell and the price goes higher, and they say, if it gets back to my level, I'm going to buy my shares back.
Yeah, and this is one that I like to set up the way it does look, like you're saying, because you had a strong, decent amount of time in that area that was the resistance that had then turned to the support. You're going to have a lot of remorseful buyers who said, I sold this at 295 and missed it on its run to 365. I'm not missing this time.
Exactly. So now if you have a situation where you gap, in other words, you close at a price and you open at a substantially different price, it shows up as a gap on a chart because there's no trading in there. So it's a gap or a blank space. If there was no one trading, well, there was no one who sold who's going to be trying to buy their shares back because they have seller's remorse. So when we get back to these same price levels going in the opposite direction, guess what? There's a lack of demand or a lack of buy orders. The seller's got to be really aggressive, really knock it down. So this is an example of a gap refilling. And you see this a lot. If we make a fast price move going one way and then we reverse and get back to those same price levels going in the opposite direction, you make a fast move right back through them. And you can see that here, right? And it's because we're just not spending a lot of time. So there's not a lot of vested interest amongst traders or investors at those price levels. So fast move up, you reverse, you make your fast move back down. You can see it. Oh, look at that. There's your things. There tends to be really aggressive trading at two places, at the beginning of a trend and at the end of a trend. And that could cause gaps. Now, this is your buyers. This is your exhaustion gap. These are the buyers who are late to the party. They've been the ones who've been watching it since down here saying, I'm just going to wait for a better price. I'm going to wait for a better price. Finally, they're like, I can't take a look at this anymore. And then they go jump in and they jack it up. Now, the smart money causes the gaps at the beginning of the trends. These are the breakaway gap. So, this thing is going lower. I'm going to be aggressive. I don't really care. I'm just going to try to get my order done. And if I have to knock it down a little bit, I'm going to. That's an interesting little thing there.
Again, the market has no emotion.
Yeah, it's ruthless.
Yep, without a doubt. Are you looking at any of the things that are closed that are on earnings after close today? Dell or Autodesk? Any of those?
Let's take a look at Autodesk. I haven't looked at that one in a while. All right, let's mark out our price levels here. So we can see. I looked at this. It's been a while, but resistance became support. I would say we got to look right down around there, right? Yeah. 282 is your level. And we're at 288, but we could see it was support. It was support.
I would say on this one, your RSI is giving you the confirmation here now.
Well, you know what, though? I wouldn't place the trade because there's the earnings coming. I guess I should probably caveat that is that if I'm going to place a trade, if I'm thinking about placing a trade and there's some news coming out that's going to affect that stock over the next.
Oh yeah, I wouldn't get in today. I want to see earnings tonight.
Yeah, exactly. But I would say the way to look at this is if the earnings make this support break, then there might be something to do on the downside here, right? Yeah. So yeah, sitting on this clear support level, we had a bit of a fast move up coming into it. Autodesk, what else is there?
Dell tonight, DELL.
Yeah, now this looks pretty, I mean, this is pretty range bound and pretty neutral. So maybe it'll move off the earnings. I guess the way you could kind of think about trading this would be, if we look at its trading range it's been in, right? So people generally trade ranges in two ways. One is they sell at the top and they buy at the bottom, or two is they wait for the top to break and then they go long, or they wait for the bottom to break and then they get on the short side. So if these earnings can push this stock one way or the other out of this range, that could be the beginning of either a new uptrend or a new downtrend, depending on which way it goes.
Are you a proponent of measured moves after that? So if it breaks that same box you drew, you could draw on top of it, and usually either does a half or a full measured move from there?
I wouldn't really say I'm a proponent of it, but I have seen some stuff that's pretty amazingly, like, kind of right on.
Yeah, that's we have a trader, Jeremy Vreeland, that comes on, does some stuff for us, and I've been impressed with. He's great at using measured moves. I've never had any luck with him personally. That's why I was asking. I have not done well with it. But he nails it with it.
Yeah, I don't really but like what I was referring to is, like, if you read in like the classic technical analysis stuff, like a flag happens halfway in between the trend, right? So that means if you took the amount from here to here, and actually we can go ahead and just do that right now. So we take that, and then this becomes a flag and breaks out to the top. That would be the target price, right? So the flag comes in the middle of the move. So I don't really use measured moves, but I've seen ones that work out, and it's almost it's uncanny that they can be so precise.
That's why, like I said, I've been looking at it a little bit more, trying to learn a little bit more about it, because I've been impressed with his success rate with it. It takes the perfect setup, and he's pointed that out to me. It's got to be the right setup for sure.
Yeah, I'm just my style is pretty simple. I just focus on levels, trends, momentum, and psychology. I know some people use some of the more esoteric stuff like the Fibonacci retracements and so forth. I mean, I've never done that, and my teaching is based on what I learned in the institutional world, and you just don't really see that kind of stuff in the institutional world. But you do see people who focus on, hey, where is this thing going to turn? Where is the next level of importance? That's what,
like they said, they almost turn on their analyst hat at that point more than the technical analysis hat.
Yeah, exactly. So what else are we looking at? Let's take a look at Bitcoin while we're talking about.
Sure.
This Bitcoin is it's just such an amazing story. Just how, no one knows who invented it. Oh yeah, look at that. All right, so let's talk Bitcoin. Now, as you can probably guess, my target would be right down here, 72.7. And as we go back, you can see that was a resistance level back here. So an amazing thing about charting and technical analysis is that you see the same patterns appear on securities that are very different. And that's because, like, even though, Dell Computer might be very different than Bitcoin, the people that are doing the trading experience the same emotions.
Absolutely.
And that's what we see on a chart. And this is why we get resistance at a former resistance level, like we saw with Apple. We get support at a former support level. And now that the support broke, we're getting into price levels where we made a rapid move higher on the way up. So there's a good chance we could make a rapid move lower on the way back down. So that's the way I would be looking at that. And this would be my target down here, down around like 72.5. But it's quite, people, I don't think really understand it at the same level that like me and you do, because we've just been doing this for so long. But if this wasn't labeled, if you didn't see the price and you didn't see that this was Bitcoin, you would have no idea what it was. It could be a commodity. It could be a stock. Oh, let's take a look at oil. I haven't looked at oil in a few days. I don't know how all this tariff stuff is going to play into it, if at all. I suppose it will in some way. Yeah. So here now, what could be more different than Bitcoin and oil? And just like we saw in Bitcoin, look at this. We got a clear level of support, right? Oh, look at this.
Yep.
This goes back to, remember the myth that the war in Ukraine caused inflation? It's actually it's the inflation that caused the war. Because, well, it's true. I mean, Russia's economy runs on oil. And when oil was down around, $32, $40 a barrel, Russia has no money. Oil
Oh,
gets up to around 100. All of a sudden, guess what? They got
a
money
lot
to
of
go
money.
attack another country.
Yeah.
So yeah, so it's another myth that's out there. A lot of people just hear stuff and they don't question it, right? They just accept it. Oh, this guy's on
Absolutely.
TV. He must know what he's talking about. But anyway, go here to oil. I mean, look at this. So we got clear support. Now, if you're not a futures trader, there's a couple different ETFs that you can use. Like for instance, USO tracks oil. United States Oil Fund. Now the charts aren't going to
Yep.
look exact because this is only open during market hours, whereas oil is open basically 24/7. But again, the point I'm trying to get is that it's like it's just this. It's the psychology. The people that are trading the oil have the same psychology as people who are trading Bitcoin. Another amazing thing that you see, I don't know if I can find a good example of it here. I'm just going to pick Apple for the hell of it. Is what we call, or what I call, the fractal nature. So you could look at charts of different time frames. Like if we just go look at the 1 day, and you could see the same things that we see on charts of longer time frames.
Oh yeah.
That's because here we're looking at the psychology of the short-term traders.
Trader.
People
Absolutely.
that seller's remorse can keep support intact because people sell and then the price goes up. And they say if it gets back to my price, I'm going to buy my shares back. And it's the opposite on resistance. So here is the 1 day chart, and look at some of the stuff we've seen. Support can stay intact, resistance can stay intact. Fast move going through prices one way, fast move coming back the other way. So this is the psychology of the day traders. If we look at, say, the 1 year chart, now we're looking at the psychology of people that are swing traders. But you see the same things happening, right? Here we see support at a former support level, just like we saw on the 1 day chart. If we look at a 5 year chart, we might see some of the same stuff happening. And this is the psychology of the people that are your buy and hold investors. The level that was resistance in April of 21 became support in July of 22, over a year later. So you see,
it translates to all of the different charts, time frames for sure.
And I think that that's like one of the most fascinating things is this fractal nature. And I never hear anyone talk about it other than me.
Yeah, no, I mean, I use the same. I'm one of the few people that use mostly the same indicators on all charts. I have friends, they have 18 different setups for all the different time frames. And to me, they all, what I use works on all of them. So, in general,
it's
maybe
really, it's really mind-boggling that, if you just look at a chart like this, just like what we looked at with the fractal stuff and the fact that you got this company that's worth $3.6 trillion finding these precise levels within points of each other. If you're a fundamental thinker or a random walk person, this stuff shouldn't happen. But clearly it does, because you can see it right on the chart.
It happens on every single chart from the tulip bubble through the Bitcoin bubble to the .com bubble to oil to gold. It doesn't matter. Like you said, what you look at, technical analysis is really a study in psychology put onto a graph paper.
When I first started, here's Citigroup, which I don't know why I brought up, but my first real trading job was for Mario Gabelli, and that was in the late 90s. And that was the internet bubble. And he was always talking about the tulip bubble. That was like one of his favorite things to talk about. There's that book, it's like the Extraordinary Delusions of the Madness of Crowds, or something along those lines. And it's not just the tulip bubble. There was the Mississippi Company, right? And then they talk about other things that caused people delusion, like when there was like a witch hysteria, like all of a sudden everyone was freaking out because they thought everyone was a witch, as we talked about last week, right? Like the Salem witch trials. But it just shows how people are susceptible to being influenced by stimuli, and they might not even realize it. Like, for example, like fashion. Why does someone think a particular fashion looks good? If we look at what people wore in the Victorian era, we think that they look silly. But back then, they thought they look good. It's like, oh, that whale baleen skirt you got on there that's got a diameter of 30 feet. That's really nice.
Listen, I grew up in the 80s when we wore parachute pants, so no one had worse style than my generation.
Oh, okay. That's another one of my analogies, and I hope I'm not offending anyone. But I compare the man bun haircut mean
Yeah.
mullet to the mullet from the 80s, right?
There you go. Absolutely.
I remember the tails. It's hard to believe like people thought that actually looked good.
Oh
But
yeah.
that's people being influenced by things and they might not even realize that it's happening. So
Well,
that's an
it's
important
FOMO. It's just another form of FOMO.
exactly. So that's why when you're making a trade, you should really sit down there and take a couple seconds, take 10 seconds or a minute. It might save you a lot of money. Like, why am I making this trade? Do I have a valid reason, or am I just
Bored and
bored?
looking for something to do,
Yeah, exactly.
and you don't want to
I
be that.
One of my favorite fashion stories is because I go up to my cousin lives up in Danbury. We go play up at his country club Ridgefield a couple times a year. Or is it Ridgeway? I forget Ridgefield. But anyway, that was the cat capital of the world. They made more hats in Danbury than anywhere else. And when John Kennedy got elected and he did his inaugural walk, he didn't wear a hat. And all of a sudden, overnight, men wearing hats went out of fashion. I mean, if you look
Yeah,
in the 50s, everyone's got like a fedora or some kind of a hat on.
absolutely.
But after Kennedy did that, it changed everything.
Yeah, no, you're right. Yeah, it's I grew, like I said, I grew up in the 80s with long pants and short socks, and for shorts, the Michigan Wolverines, got everybody into that, the Fab Five. We all had shorts that went to our ankles and socks that only went to our ankles.
I was watching the Motley Crue. She's got the looks that kill video.
Yeah.
Can you imagine if they came out with something like that? Where they're like locking all the girls in cages and
Oh, they'd shut them down in 30 seconds. Now that's like watch a TV show. One of the TV shows that I love to watch now to see how it wouldn't you couldn't get through. Cheers.
Yeah,
They were so sexist in that show and things, like it just amazes you. Like, oh, you can't say that. You can't say that. Oh, they did. Never mind Archie Bunker and those days.
well, look at the movie Airplane, right?
Yeah.
Like,
Oh yeah.
everything in that movie that was funny, like nowadays is politically
Mel
incorrect.
Brooks, he wouldn't be able to make a movie nowadays.
Yeah, like the
Blazing
nun that
Saddles.
speaks jive. Remember, she's like, "I'm
Yep.
stewardess. I speak jive." Yeah, a couple other. The guy commits suicide because he's so sick of hearing the story. The girl's crying, and the guys keep coming up and hitting her. And then how about like little Jimmy comes into the cockpit?
Yeah. Have you ever seen it? Yeah. I'm not going to repeat that, but yes.
Yeah.
Or when he just makes fun of Kareem Abdul-Jabbar.
It's like, do you like gladiator movies?
Oh.
But anyway,
Well, on that, Mark, we got to take off here. Thank you so much for joining us. I know you're coming back tomorrow to look at some stuff. Maybe we'll take some requests from the crowd, see if some charts they want us to look at tomorrow when we're on.
Yeah, that would be great. And if you could follow up with that email that we talked about, I would really appreciate it.
I will do that, sir. You have a fantastic day, and we will see you tomorrow.
Okay.
Quasar Markets Live at 11:30. We're back with Matthew Tuttle and Jeremy Vreeland with the Rebel Market Podcast.